what's going on? This is Jacob from Millennium Finance. Today I want to talk about macroeconomic effects that have been pushing the market higher despite the trade war, despite coronavirus, despite the war with Iran, despite everything. The market continues to push higher. Today I just want to go over a couple of the macroeconomic factors that I think are affecting the market and bringing it higher. So if you look at the S&P, SPY over here, or the SPX, the S&P 500 index, obviously. Over the last 3 years, massive gains, 43%. That's really good. Despite even this big pullback last Christmas, the market just continues to charge higher. Despite global markets also being not as bullish as the American markets. So today I just want to go over some factors on why I think that the U.S. market is so powerful compared to the rest of the world. If we go to the bonds, if you look at bonds right now, they're really, really weak. So a lot of the money that would be going to bonds is ending up going to equities, and specifically U.S. equities, because the biggest bond is, they're the most sold bonds are U.S. bonds, U.S. government treasuries, so U.S. dollar treasuries really. And if you look at the U.S. bonds, they're really, really low. They've been below 2.5% since June of 2019. So if it's lower than 2.5%, and there's equities out there, stocks that have 3 or 4% dividends, plus the potential to gain share price, and they're a safe company that probably won't decline too much unless there's a crash. It's almost better just to put your money into a large cap, dividend paying, stable stock than to buy a bond for 2%. Right now it's 1.6% at the best for a 10-year. So 1%, 1.6%, you can, the Apple dividend is almost 1.6%, and you could have made 50% or even 80% last year on the share price too. So why would you go and buy all these bonds that are such a low rate? So I think in the last year, real estate and utilities have performed really well. So right here, I'll bring up the XLU utility sector for the S&P 500. And if you look at this chart, it performed extremely, extremely well. Better than energy, better than finance, better than healthcare. And if you think about the sector, utilities, they're electrical companies, natural gas, heating oil, whatever. They're very, very stable. They have long-term contracts. They're kind of locked into a certain area where they have a set amount of customers. There's no China exposure. It's completely domestic. And most of them have good dividends, and they're very, very stable because it's just the nature of a utility business. It's very, very stable. So that, I think a lot of people that instead of putting money into bonds, they put their money into utilities, REITs, so real estate. And I think that low bonds are a direct reason why the XLU is so high right now. And I think it was only outperformed by tech. So that's really, really impressive. So if you look at the 3-year gains, or let's say 1 year really, because the bonds have gone down significantly in the last year. So a 1 year gain is 30%, plus maybe 3 or 4% in dividends. That's good in a market that everyone thought was going to go sideways, very volatile. the safest and the most stable industry perform the best in a volatile year. So I think that's something to be said about that. It's significant. Another contributing factor I want to address, especially for the recent rally in the last few months, starting in October, is probably because the Federal Reserve went back and lowered their overnight rates to from 2. They were raising them, stabilized around 2.4, and then as you can see in July, they cut them. Powell did. Now they're sitting at 1.5. So that's a significant drop. Helps businesses with their short-term loans, and it keeps the money supply, or the flow of cash, going with it within the corporate structure, which is important for business, of course. Another factor, probably one of the biggest factors, especially for the recent rally in the last few months that just blew the top off of the 3,000 S&P 500 all-time high. What really made it break through was the Federal Reserve saying that they're going to continue to increase the balance sheet back to its high of $4 trillion. So you can see this is probably one of the most interesting charts that's not really shown very much. So if you go back to the before pre-recession, the Federal Reserve was only putting out less than $1 trillion, 800 billion, I think that would be, in total currency, in total treasuries out there. And then obviously in the recession, they increased the balance sheet to help the economy. Then for whatever reason, 2012, they decided to really, really blow it up. 10, there was a boost from 2 to closer to 3 trillion. Then 2012, they blew it up from 3 all the way to 4.5 trillion total treasury dollars out there, which is a crazy amount of money. And then in January of 18, that's when they started to bring their what do they call it? The contraction, I guess. Yeah, the contraction of their balance sheet back down, and it wasn't really making too much of a difference. There was the incidents with the money supply and the overnight lending. I think most people that trade didn't really understand it. It was only a headline because certain people said it was. But for the people that really understand the money supply, they were wanting the Federal Reserve to increase their balance sheet again. So eventually they did. Now it's definitely a contributing factor to the recent rally. You can see that they're pumping up the balance sheet again, putting more treasuries out there, more cash, increasing the total cash in the economy, which obviously is going to benefit all companies. The last factor I want to bring up into why the S&P 500, or the total stock market, or especially specifically in the U.S., is so high right now. If you look at the baby boom generation is about 70 million people, and they're all either recently retired or in retirement, or they're about to retire. And the baby boom was pretty financially well off compared to like the silent generation or whatever when they retired. So the baby boom, as you can see by this chart, has a median retirement money saved up of $150,000. So if you multiply 70 million people with the average or median of $150,000 each in retirement, a lot of that money is going to go into the stock market. So, and that money, because it's such a big generation of people all retiring at once, maybe that amount of cash flow wouldn't have went into the market at this moment if there wasn't the baby boom all retiring at this time. So there's a lot of retirement money being put into the stock market for the baby boomers so they could have an income through the retirement. So that's another inflationary factor, at least I believe, for the current stock market. Thanks. That's all I want to say today.